So now another chapter, we could say, we discuss how to use accumulation distribution indicator. So the AD indicator is used to confirm the trend and search for pivot points which appear when the indicator line deviates from the price chart. It is generally accepted that in an uptrend, most closing prices are formed near the high of the trading period. The arrival of new buyers to the market is accompanied by an increase in volume and, as a consequence, an increase in price. In a downtrend, the situation is the opposite. Most closing prices are formed near the low of the trading period. The emergence of new sellers in the market is also accompanied by an increase in volume, as a result of which the price falls. Thus, using the accumulation distribution indicator, one can note an increase in trading volume, which usually leads to a continuation of an upward or a downward trend. It also helps characterize cash flow. If the indicator curve rises, the financial interest of buyers increases. If the curve declines, sellers begin to dominate the market. So the AD indicator is used to generate following signals. First, it confirms for us the trend, then it shows us a divergence, and it also helps us to identify technical analysis patterns. So let's discuss the first one, the trend confirmation. So to confirm a trend using AD, you first need to add an indicator to the price chart, of course, then determine whether the price movement has a clear direction. If the indicator line grows following the price and forms similar lows and highs, the trend is considered confirmed. So the example here displays the 4-hour oil futures chart. Here you can see the price is growing and forming each new low and high higher than the previous ones. Now let's mark the same lows and highs on the AD line. In this case, the AD line is growing as well as the price chart. New lows and highs are also formed higher than the previous ones, so consequently the upward trend in oil futures has been confirmed and you can open long positions. Next, we discuss the trend divergence. So the divergence between the price chart and the indicator line will indicate a possible correction. To spot the differences, the direction of the charts are also compared, and then key highs and lows are noted on both. If the price forms a new depression and the AD indicator chart forms a low above or at the level of the previous one, convergence occurs. In this case, a reversal signal is formed. The downtrend is not confirmed and there is a chance of an upward correction or a trend change. So let us consider another option for divergence in a downtrend. So if the AD line makes a new low below the previous one, and the price chart makes a new low above or at the same level as the previous one, a reversal signal appears. In this case, there is no confirmation of the trend, there is a risk of correction or a trend change. So look at the 4-hour time frame in this gold futures chart. Until the indicated point, the price was trading in a pronounced downtrend. The chart shows that the price has formed a low higher than the previous one, and the accumulation distribution line has set a minimum below the previous one. So a divergence has appeared, and it is a sure signal to trade in the direction opposite to the trend, that is, to buy. Here you can see that after the divergence appears in a downtrend, it immediately appears in an uptrend. The price sets a new high above the previous one, while the AD line sets a new high at the level of the previous one. So if you mentally connect the highs on the price chart as well as the highs on the AD chart, with straight lines of course, you can see that the lines go in opposite directions. This means that a divergence has formed, a sure sign of an impending correction or a trend reversal. After a divergence has formed in an uptrend, the price falls and starts a descending correction. Sometimes the accumulation distribution indicators follow the price movements very closely. Because of this, the divergence in the chart may not be so obvious. So the trader needs to carefully monitor the divergence between the lines so as not to miss a profitable signal. So now let's discuss the patterns that it generates. So in addition to confirming the trend and forming divergences, the AD indicator can draw patterns. At the same time, They are quite likely since they take into account the volume. So the second advantage of the accumulation distribution patterns is that they tend to appear before similar signals in the price chart. This gives you the advantage of an early entry at better prices. So the chart here shows a false breakout pattern followed by a sharp price drop. Note that after the pattern had formed, the prices for selling the assets were the most profitable. So this screenshot shows 1, 2, 3 pattern formed by the AD line. As we see in the first case, the appearance of the pattern led to a trend reversal. In the second, to its continuation. So this is an example of a false breakout pattern in a downtrend which preceded an upward price reversal. Finally, the chart shows 2 double bottom patterns which were formed in a downward trend and allowed one to trade in a correction. So trading the AD line patterns is no different from trading the price chart patterns. As a rule, you need to wait for a pattern to form. Then, when the key high or low is updated, it generates a buy or sell signal, depending on the direction of the pattern formation. Such technical analysis patterns are a triple bottom, a triple top, a pennant, a flag, various triangles, and others also work well with the accumulation distribution chart. So now let's discuss the differences between the accumulation distribution and on-balance volume indicator, the OBV. So the on-balance volume indicator, or OBV, we can say in the short form, is one of the first indicators designed to analyze cash flow. The OBV indicator was developed in 1963 by Joe Granville. The OBV works according to the following principle. If the current candlestick closes higher than the previous one, the volume of the current candle is added to the volume of the previous one. If the current close is lower than the previous one, the volume of the previous candlestick is subtracted from the preceding one. In this case, the trading volume can be negative. Therefore, the OBV indicator sums volumes when prices rise and subtracts them when prices fall. The OBV line reflects the accumulated volume as in the accumulation distribution indicator. A rising line indicates an uptrend and a falling line indicates a downward trend. Both tools are volume-based indicators, and the OBV indicator measures buying and selling pressure and strength. It is calculated by adding the volume on rising days and subtracting it on falling days. And so the AD indicator has a more complex calculation formula and takes into account the closing price of candlestick relative to its high and low. If the price of the candlestick closes around the high, then the closing position value will be positive. This means that in the future, the volume of this candle will be added to the running total. If the price of the candlestick closes near the low, the closing position value will be negative. This means that in the future results, the volume of this candle will be subtracted from the accumulated total. The AD indicator analyzes the market differently, deeper than the OBV indicator. However, they are used in the same way, measuring buying and selling pressure. So as can be seen from the chart here, their lines basically often repeat each other. The AD indicator is not a full-fledged trading system, but it can be a good auxiliary tool for choosing the direction for trading in a trend system. It is recommended to support AD signals with other means of technical analysis. So to use the indicator for FX trading, it is better first to analyze currency future charts and then transfer the results to the spot chart. Let's summarize now everything we learned from this video. First, Mark Chaikin has developed a unique market analysis tool. In addition to prices, the indicator analyzes volumes, and volumes are the engine of the market. Moreover, the indicator is easy to use and definitely worth trying. If market participants accumulate buy positions, the AD line will rise. If the period's total volumes of sales increases, the indicator line will head down. Due to its simple interpretation, it is enough to look at the indicator chart once to understand in which direction it is profitable to enter trades. If you master divergence signals, you will be able to understand that the trend is exhausting. So in this case, you can trade the market during a correction. Also, upon the correction completion, the indicator usually generates a corresponding signal which will indicate the continuation of the impulse. So, like any technical analysis tool, the AD indicator has a number of disadvantages. However, if you clearly understand for what purpose it is used and also employ additional technical analysis tools, such as other indicators, support and resistance levels, price action patterns, and so on, you can create a profitable trading system based on AD. Again, that's it from my side. Thank you and goodbye.